This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. Welcome back to the show. We got another busy week this week. We got another update from the Bank of Canada. We've got a blistering jobs market report, which is going to complicate the picture even more. We've got a resurgence higher in mortgage rates. We've got predictions for rate cuts, and of course, an update on some developments in Vancouver, or rather lack thereof. So let's get into this week's show. We have to start things off with what I touched on last week, which was there's this narrative that's been forming in the housing bull market community, which is that housing's starting to rebound, and anecdotally I can tell you that it is. Open houses are busy, listings are selling really quickly. There's a lot of them that are going back into multiple offers. It's a head scratcher considering really there's not a whole lot that's changed in the past 6 weeks, but we're in a completely different market. And so the narrative that's building now is, well, this is the end of the bear market. Housing is going to accelerate higher, especially heading into the spring market, and the Bank of Canada is going to cut rates later this year, maybe 2, 3, 4 times. And I'm thinking, well, if I'm the Bank of Canada, I'd be really concerned about inflation. That's obviously what they've come out and done. And, really to engineer, a continued slowdown in inflation is they need to weaken the economy, they need to weaken the labor market. So effectively, they almost need effectively a soft recession. And, rising house prices doesn't really coincide with recessions and a slowing of demand. In fact, housing is really a huge component to household wealth, household sentiment. If your house price is going up, you feel good, you spend more money. So the last thing the Bank of Canada is going to want to see is, oh, look, the housing market is accelerating. Things are going back into multiple offers. Let's cut rates. So that frames up this week's video because we actually had an update from the Bank of Canada. They came out this week saying, part of the reason why we paused rates was because Canada's Canada's private sector is highly levered, and we're really worried about the damage that we could do to the private sector. And obviously, we're not in the same breath as the U.S. Okay, here we have way more debt. Your longest fixed rate mortgage you can get is 5 years, which is so effectively there's a lot more interest rate sensitivity, and so that's essentially what the Bank of Canada came out and obviously concluded. Now people will say, well, hold on a minute, isn't the Bank of Canada's whole mandate 2% inflation? Yes, but it also has a mandate for financial stability. So aka a house price crash, it doesn't create financial stability. So they're kind of weighing these two things. Now, again, what is going to prompt the Bank of Canada to cut rates? Well, I can tell you for one, they have explicitly come out, the Fed, every other central bank, is they need to slow the economy. They need to weaken the labor market. They need people out of jobs. That's the sad reality. They need some people to be the sacrificial lambs and lose their jobs in order to create some slack in the economy and to push down wage growth. And so we have this back-to-back months now, I think 3 months in a row, of blistering jobs growth. So the market was expecting the Canadian economy to add 15,000 jobs in the month of January, and we added 150,000. So we added 10 times what the economists are paid to do. So I'm not going to call StatsCan the random number generator. Clearly, there's something to this data. I don't put a whole ton of weight on it, but listen, we've had 3 months in a row of job gains, job growth that has far exceeded the economists' expectations. Now, my good friend Ben Rabideau with North Cove Advisors helped people break this down, because if you remember last month in December, there was this huge revision. I think they came out and basically they revised it a month later and said, okay, it wasn't 100,000, it was 60,000 jobs. So they revised it 40,000, pretty big revision. So we'll probably get another revision, but nonetheless, to go from 15,000 to 150,000 jobs. Clearly, the labor market is running hotter than everybody is aware of. Ben Rabideau pointed out this good tweet thread here. I'll just read it to you. So here's from Stats Can. Says notable employment growth among the group that includes, quote, non-permanent residents. Well, over on a year-over-year basis, employment for those who were not born in Canada and have never been a landed immigrant was up 13.3% in January compared to the growth in total employment of 2.8%. So what we have here is a boom in employment among non-permanent residents. And again, if you remember what the government of Canada is doing is they have been very, very focused on ramping up immigration, temporary work permit visas to basically help alleviate some of the massive job vacancies openings that we've had over the last 12 months. So they just rammed all these sort of non-permanent resident immigrants through the door and asked them to basically fill these jobs. And so that's really what we're seeing. We saw the largest quarterly change in net non-permanent residents in Canada just in the last several quarters. So the short answer here is effectively immigration is largely responsible for the job growth that we're seeing over the last several months. So this is more of a temporary spike. These numbers are massive temporary spikes. So again, you're doing your best to interpret noisy data that's going to jump around from a month-to-month basis. But nonetheless, this is jobs data that the Bank of Canada is going to look at and say, I don't know, the labor market doesn't really seem that weak. Now, what you do see in the report is wage growth has slowed from 4.8% to down to about 4.5%. Now, the Bank of Canada still thinks 4.5% wage growth is still too high, so it needs to continue to come down. But the long and short here is post this announcement of the jobs market over the last week here, the Canada 5-year bond yield has been ripping higher. It's now back north of 3.3%. So you will see, the hopes and dreams of lower mortgage rates, which we saw, your 5-year fixed mortgage rate came down from about 5.5% down to about 4.8%. It's now going to be shifting back up. You should see 15, 20 basis point move probably starting next week. So if you're about to get a mortgage, you better call your mortgage lender today and secure a rate hold, because those rates will surely be going up next week based off the movement, the rapid movement in the bond market. Now, again, we're off about 50 basis points off the low. So you had that 5-year bond yield at one point down to about 2.8%. Which was, again, giving people hope, because at those levels, if they held, which was the key thing, if they held, you would have seen mortgage rates in the low 4s in the spring market, again, potentially adding fuel to the recent rebound that we're seeing. But this sticky labor market is ultimately going to be the crux for what I think is going to be revised slowdown back into the housing market. I'm struggling to see the housing market really taking off so long as rates sort of muddle around here in the 5s. And so, again, this strong labor market, if you look at actually what's interesting enough, even the OIS markets, which price sort of interest rate futures, just a couple of weeks ago, they were expecting 2 rate cuts from the Bank of Canada. They've suddenly reversed course and said, okay, we're now expecting zero rate cuts from the Bank of Canada this year. Now, again, that will probably change in the coming weeks, months, as data starts to come out, new information comes into the system. We're going to get Canada's CPI print for the month of January. That will come out next Thursday, February the 16th. That's going to be extremely important. That'll probably push bond yields around. So as long as what we're really seeing here is a lot of volatility. I think anyone that has extreme strong conviction in the markets today, I think is honestly kind of kidding themselves. I mean, there's so many data prints. You can see just the volatility in the bond markets, that the bond market doesn't have this thing figured out. Are we getting disinflation? Or are we getting structurally higher inflation because the labor market refuses to materially weaken, at least not yet. And so that's kind of my call. It's similar to last week, which is I think that this idea that the bear market is over, I think, is premature. I still think that rates at these levels, they're sticky. They're being sticky, and it is going to create some damage. So I think what looks like it's playing out is potentially higher for longer. So maybe the Bank of Canada gets 0 hikes in this year, and that leaves your variable rate mortgage for the year stuck in the mid sixes. I mean, the mid sixes on a variable rate mortgage, that sucks. That's high, given where house prices and debt levels are. And so, we can see already some bodies floating to the surface. You had Mandel, a large developer here in Vancouver, which I had flagged. I've been flagging these guys for a couple of years, so not really overly surprised. But, it was a company that was doing mass acquisitions, an overseas company from, originally Chinese money, coming into the Vancouver market. It hasn't been here that long. It just started land banking, just started accumulating land, buying land, choosing to refinance that debt every couple of years. Because again, so long as your land price increases, right? In Vancouver, your land price increases 10+% a year. It's just what it's been doing. So it allows them to go back to the pool, go back to the piggy bank, and ask for a refinance because you've got equity in the property. And so they were doing that, deploying it on many sites all across Vancouver. And again, when the tide goes out, you're able to see who's swimming naked, which is, okay, the tide went out, interest rates went up 450 basis points in the span of less than a year, and your land values are now falling as a result of that. And so you get the margin call, which is, hey, listen, we're not refinancing you. You guys figure it out. And by the way, I want my money back. And there's no new money to come in and actually pay back those existing debts. And so you have essentially what is almost a Ponzi that is now gone up in flames. Over $1 billion in real estate holdings, over $700 million in debt. So a highly levered entity, and there will be more. There will be more at some of these smaller, mid-sized, more fly-by-night that ultimately overextended themselves, and we'll see that in various aspects of the housing market. So I've got a couple names that I'll be keeping an eye on here. Certainly not at the wills to share here publicly, but I don't view this as a contagion moment. But I do think what's going to happen is you will see credit tighten. You'll see more private lenders, alt lenders of that nature. They will start tightening credit on other developers, people. So it's just going to make it more challenging. The cost of debt will probably increase as well. You'll see loan to values fall, and so that will start to pinch again some of the more levered, some of the more fringe developers. And again, ultimately, what's going to result in that is you'll see a consolidation in the space. The big developers coming in, buying some of the smaller ones that aren't able to move forward, and you'll see a massive slowdown in new housing supply. You won't have a supply issue in the next couple of years. The construction pipeline is actually quite full. You've got a lot of units under construction, nearing completion over the next 24 months. But you will see those supply constraints. They'll become more evident 5 to 6 years down the road, because that's sort of your pre-sale construction timeline. So that's kind of what I'm looking at this week. As always, hope that helped. Appreciate you tuning in. We'll see you next week.